Why are there so many layoffs? Have you noticed like tons and tons of tech companies have laid off tons of employees lately? Better.com laid off thousands of employees, and in June, just recently, Coinbase cut off 18% of its workforce. So maybe you've been laid off, or worried you might be next, or you're just looking at this and you're thinking, hey, like the company I'm working at's doing really well. Like it seems like everything's going fairly well. Like, yeah, sure, the stock market's having problems, but like our revenues are good. Like, how come there are so many layoffs? I've been hit up by a lot of friends recently asking this exact question. So I thought I'd at least share my perspective on why it's happening, particularly for tech companies. So the first thing is valuations have been insanely high for the last couple years, for tech companies. In some cases, enterprise software businesses historically have traded somewhere between like 6 to 10 times revenue. Last year, they were trading I saw deals trading as much as 100 times revenue. So you have like this huge increase in valuation. And that was driven by the fact that there was tons of money being printed and pumped into the system. And so venture funds were raising tons of money. They were investing that money. And then everyone was competing, and that was pushing up prices. And then they were investing more money into those companies. And so these companies had extremely high valuations. They were flush with cash. And because their valuation was so high, there was a tremendous amount of pressure to grow at all costs. And so they had this big war chest of capital, and they were spending the money to hire tons and tons of employees. Well, fast forward to the last 3 months, stock market starts to free fall, particularly anything related to tech. Some of the best tech companies out there have dropped by 70, 80% just in the last 3 to 6 months. It has been brutal in the public markets. That ultimately is going to flow back to private markets and as well as public markets. So you see this same thing happening where valuations have come down drastically, and investors accordingly have become skittish, right? They're like, I don't know that I want to invest, particularly at a high valuation, when I'm seeing the companies that went public just recently decline so much in value, right? So I'm going to pull back. I'm not going to invest. And if I do invest, I want to come in at a really good valuation. And at a much lower valuation, entrepreneurs don't want to take as much money, because the more money you take into your company, the more dilution, the more you're basically giving up of the company, both in terms of future profits as well as control. And so founders are left in this tough situation where they can see that there's a potential recession on the horizon, right? Where revenues may start to decline, or even if they don't decline, it will be harder to get to acquire revenue. It'll be more costly. And then coupled with that, venture investors, growth equity investors, and public investors are less willing to invest money into these companies, particularly if they're burning a lot of money, because they don't want to invest and then immediately see the value of the company drop when it goes public, or there are no acquirers, or they need more money, or whatever the case may be. And so what that's doing is that's tightening up available capital. So if you're an entrepreneur, what do, right? You may have just raised a whole bunch of money, right? Maybe 6 months ago, 7 months ago, 8 months ago, you closed on this huge monster war chest of $100 million or a couple $100 million, right? That was super common 12 months ago. What do? You still have a lot of money in the bank, but now you're looking forward and you're like, I don't know, based on how much money we are burning and we are spending every month, I don't know how much longer our company can last before we have to go back out to markets to raise more money. And if I can't raise that money, I'm going to be in a tight spot. So what a lot of VCs are telling entrepreneurs to do today is lengthen out your runway. Now, what that means is, let's say every month you're focused on really growing the top line of your business, really growing the revenue side of it, right? But to do that, you have to spend, $10 million of your capital that's available. Well, that means that every month you're spending $10 million to keep growing, and then you add $100 million, then your runway is 10 months. But that means at the end of 10 months, you need to raise more money, or your company is going to go out of business, right? So those companies, they're looking at this and saying, hey, I need to extend this out for not 10 months. I might need to get like 18 to 24 months. And the only way to do that is really to cut. The other thing that's really like making it even worse is that a lot of the companies, like I said earlier, had these huge war chests of capital. They were spending and hiring people like crazy. And that, of course, resulted in increased labor costs and this like whole, people leaving their companies and switching to other companies and so on and so forth. But a lot of companies overhired, right? Elon Musk just recently said they're going to cut their staff by 3.5% because they grew a little too aggressively in some areas. That's super common when things are good, right? Companies will raise lots of money and then they will usually overspend, but they're happy to do so because they're growing so fast that they can kind of make up for it, and future investors will invest more money because they're doing so well, et cetera, except for when that music stops, and that's not the case. And raising more capital becomes harder and more expensive. So ultimately, that's why you're seeing so many of these tech companies start to lay people off, is that they're really trying to extend their runway before they need more money. Today, smart companies, even if revenues are really strong and growing, they're smart if they start making cuts and start pushing to more profitable businesses. And those that don't make the changes now, come 6 months from now, 12 months from now, when they run out of runway, are going to go out of business. And I think that's why a lot of economists are saying, hey, we think a recession is probably going to hit in Q4 of this year or Q1 of next year, is because that's when you'll start to see a lot of these companies fully run out of money and start shuttering their doors. And that will have a huge impact because it's not just a 18%, 19% reduction in staff, it's 100%, right? And everybody's doing it, and then it's really hard to find jobs. So what does this mean for you if you are at a tech company? You're seeing the writing on the wall, right? Maybe you're at one of those tech companies that just raised like a huge round of capital 9 months ago. Should you be worried about layoffs? Probably is the answer. So here's my recommendation. Take some time and be really honest with yourself about your role at the company. Think about the things we talked about today. So one of those is companies are trying to extend runway. Now, you can extend runway in a couple ways. One, you can either bring in more revenue, right? Or you can cut costs. Generally speaking, if you are generating revenue and doing well at that, you're probably not going to get cut, right? If you're part of the revenue generating team and you're doing a good job, probably not going to cut. Probably the riskiest jobs and the revenue generation side are in marketing, because it's harder to attach marketing directly to revenue, right? It's a little bit more gray. If you are in any sort of role that is kind of a nice to have, frankly, for the company and not a need to have, you should probably be a little bit worried. So that's why you're seeing some companies start to lay off people and, their diversity and inclusion side of the business. Probably a necessary thing for the business, but if they have to choose between going out of business and having those types of support roles, that's why you're seeing some companies start to cut that. If you are in a role where you feel like your position might be at risk, my recommendation is start looking for another job opportunity now and focus on businesses that are at break even or that are already profitable, because those are the companies that will be in the best position to withstand a coming recession, because they're not going to be reliant on capital markets to raise more money to keep their business afloat. And that will put you in the best position to keep your job. Even if that means taking a pay cut, it might be worth it from a job security perspective. Anyways, I hope that's helpful. We're going to talk a little bit more about some of the things that led us to where we are today, including my next video where we're going to talk about how does inflation impact VC.